And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. At the end of 2019, as it draws closer, we're recapping the year in ETFs. Not just which funds were the strongest performers, but which ones had the most impact on the ETF industry and the market more broadly. Joining me today, Todd Rosenbluth, Senior Director of ETF and Mutual Fund Research at CFRA. Kim Arthur is the founding partner and CEO at Main Management. Your votes for 2019 ETFs of the year, again, not necessarily best performers, which had the biggest impact. You like home builders.
Bob, I want to go with the home builders, ITB, for the following reasons. One, it's not sexy like the semiconductors where everyone likes 5G or some chatter around it. Beginning of the year, mortgage rates were just under 5%, and everybody hated the home builders because rates were too high. Then the second half of the year, recession fears kicked in, and everyone said, we can't buy a home builder because of recession fears. In the meantime, these home builders have clicked out a 50% return, almost 2x the S&P 500, and they weren't loved any of the way.
Mortgage rates below 5%. I just want to point out the passing of a friend of CNBC, Paul Volcker, the former head of the Federal Reserve. 1981, mortgage rates, 80 and 81, were as high as 18%. When I bought my first house in 1985, I paid 11% for that mortgage, for my mortgage. And today, if you go around telling people about 18% mortgages, the country would collapse. I know I'm being melodramatic, but what a change. And Volcker helped break the back of inflation. Of course, it did cause a recession. I remember President Reagan saying, when is it going to work, Mr. Volcker? And there was a little tension there, but ultimately history vindicated him, and that 5% being a good example of that legacy that he had there. Todd, you have something a little bit different. You are talking, tell us what you're talking about there.
Yeah, so BNDX, talking about bonds. So this has been the year of the bond ETF. Record inflows, over $140 billion of net new money went into an asset class that's roughly 20% of the overall market. BNDX is a surprise hit this year. International investing, sovereign bonds had negative interest rates for much of this period of time, and investors continue to allocate towards international bonds to round out their portfolio. Vanguard's BNDX has been the biggest beneficiary, the biggest, most popular product around, and it's extremely cheap as usual.
But if bond yields are starting to go up internationally, doesn't that not bode well for this, for the price of this index?
Well, obviously you get the benefits of that from a price return standpoint. So they're looking, the yields are going up and it's slightly more attractive. We think investors continue to be diversified, and BNDX is a great way of doing it internationally.
Okay, now let's talk a little bit about 2020. Do you expect any ETFs to break out or see outsized performance relative to their benchmarks? Kim, give us your outlook. What's going to break out?
I want to go way down the market cap structure. I want to talk about microcap stocks, IWC. A lot of people are talking about emerging markets. Here's something that's priced the same. 13 times this year's number, 1.6 times book, and it's got a 1.4% yield. If you look at it relative to the S&P 500, it's in the bottom decile for those same factors.
I want to make it clear what a microcap is. We're talking, what, 50 million to 400 million, 500, is that fair?
That's
What's the difference
fair.
between a micro cap and a small cap?
So small cap is going to be the 600 stocks that are below the S&P 500 and the mid cap 400. These micro cap stocks, there's 1,400 of them. You got a lot of them. There's a lot of them that probably aren't A students.
Are we talking about stuff that's on the pink sheets too?
No. These
all
aren't
listed
on the pink sheets. These are all listed, listed securities.
And why, just make the argument again, why am I interested in micro caps? Given how volatile they can be, individually, they're extremely volatile, but even as a group.
Correct. So what happens when the global manufacturing PMIs move from below 50 to above, which is the direction they're going right now? You want to be long size, small cap, micro cap. You want to be long international, and you want to be long value.
You're saying they have similar characteristics. Sometimes they will trade similarly.
Correct. Okay. That's exactly right.
Got it. Okay. Todd, you're talking about quality. QUAL we've talked about many times this year. Moderate earnings growth, lower volatility. What's quality mean to anybody?
Well, it is, again, in the eye of the beholder. But what iShares does with the MSCI-based product QUAL, it's the antithesis of what Kim was talking about. These are blue-chip, high-quality companies. Among these are large-cap companies like Apple. You'd find within the portfolio Johnson & Johnson. These are strong companies that, as you mentioned, if the earnings trends tend to be more moderate but positive,
right.
the economic trends are positive, this is a good way of going, and it's beating the S&P 500 this year and is likely to do well again in 2020.
Right. So you get low vol companies like, Pepsi, and then higher volatility companies like Facebook in there. So it tends to tilt towards lower volatility, it seems to me, but good earnings growth.
Correct.
Define quality. That's the point.
So these are going to be higher growth companies than you'd find within a traditional lower volatility portfolio. These are companies that are standing out, that still look good to us at CFRA Research.
Okay. How about what might surprise us in the ETF market in 2020? Todd, anything surprising coming down the road?
Well, so we have actively managed ETFs that are going to be coming in 2020 for the new regulatory environment that's happened, non-transparent ETFs. There are some not actively managed ETFs that are doing well. Kim happens to offer one of them separately, but we think we're going to see mutual funds actually convert into an ETF to use the benefits of this structure, the tax efficiency behind it. You've got T. Rowe Price, you've got Natixis that are going to do it the traditional way. We think others are going to do it in an untraditional way.
The untraditional way being what, Kim? And what is going to happen here that's different? I mean, look, I've said many times, I'm fine with non-transparent ETFs, but just because you're a loser as a stock picker in an active mutual fund, it doesn't mean you're going to be a winner in a different wrapper, called an ETF wrapper, if you're an active stock picker. I guess you have to explain this to the viewers. Why is this suddenly going to transform?
Well, I think you're spot on there, Bob. I think performance still matters and cost still matters. So if you try to wrap it around and it's high cost and bad performance, I don't care if it's a non-transparent new whiz-bang theory with the ETF wrapper, it will not sell.
Yeah.
But if some of the strategies that are coming out from T. Rowe Price, these have strong track records, they have relatively low cost structures, they will gravitate.
No
there
problem
are
with
good
doing
active
that.
managers, not just bad ones.
What I think that this is a great opportunity to find really good active managers at lower prices, which is exactly Jack Bogle's ultimate revelation 40 years ago, that it's not that there isn't any good active managers, it's just that they charge too much and it destroys the alpha that they generate. Maybe this will get closer to Jack's dream.
And this marketplace is still very nascent. Like Todd mentioned, we have a product that's been out there for 2 years and has 550 million. It's the third largest. At 550 million, there's a lot of runway for people to get into it.
Okay. Of course, next year also marks the start of a new decade. So I'd be remiss if I didn't ask about the stock picks of the decade. Again, not necessarily the top performers. ETF that had the most impact from the year 2010 to now. Recent launches included, Todd, your vote. Top ETF of the decade.
So I'm highlighting IEFA. This is an MSCI EFA-based product that is lower cost than what's out there before, and just 7 basis points. It has really enabled asset allocation and allowed U.S. investors to broaden their portfolio to include companies like Nestle, like Toyota. These are blue chip companies that they know they just don't have within the S&P 500. Very low cost, well diversified.
I want to make it clear, and remember, this is Europe, Africa, Far East, so this is a very broad subject. You're not just arguing it's cheap, it is cheap, and that generated a lot of money, but people have, United States investors who've been looking to go abroad have been using this fund to invest in. This is the main reason you're picking it.
That's correct. So U.S. investors tend to be U.S.-centric with their portfolios, and so having a low-cost, well-diversified product tied to a benchmark they know has made it easier for them to get the benefits of that diversification.
Kim, your vote is a nod to our friend we just mentioned, Jack Bogle.
Exactly. And what I'm going to do, Jack Bogle brought us VTI. It's the all-market U.S. index here, and I'm going to match Todd and raise him because the expense ratio in it is 3 basis points, not 7 basis points. And this is, Jack Bogle did more than anyone else to democratize investing in U.S. equities. The last thing I'll say on it is this product during the last decade, outperformed the S&P 500. And if you go century to date, almost the past 20 years, it's beaten the S&P by 50 basis points a year. That's significant.
Let me move on here. Much of 2019 has been defined by the U.S.-China trade dispute. But the recent tension with China doesn't just highlight differences over trade and tariffs. It also highlights differences over political systems and our different views of freedom, both economic and personal freedom. And not surprisingly, there's an ETF for that. You knew I was getting to this, right? The Alpha Architect Freedom 100 Emerging Market ETF. The symbol is FRDM. This freedom-weighted ETF assigns higher weights to what it considers to be freer countries and lower weights to less free countries and markets, including the worst offenders. Let's bring in Perth Tolle. She's the founder of Life and Liberty Indexes and the sponsor and the indexer of FRDM. We have been debating this a lot this year, so thank you very much for being here. What's the idea behind this? First off, explain how you decide what country gets a bigger weighting. For example, Taiwan has the heaviest weighting here by country. That's an interesting choice. How do you make these decisions? What kind of factors go here?
So the inputs that go into this have to be objective, they have to be transparent, and they have to be robust. So we use the data think tanks from the Fraser Institute, the Cato Institute, and the Friedrich Naumann Foundation for Freedom in Germany. And they have a quantified set of human freedom variables of 79 different freedom variables, ranging from the rights to life, rights to liberty, and the rights to property.
So it's a little hard because we put the flags up here, but not everything else. Put that back there. I just want to show it. Number one is Taiwan at 25%. Number two is South Korea at 19%. 3 is Poland at 14%. 4 is Chile at 13%, and South Africa is 8%. This is a very interesting choice. What's basket? Did you look at 160 countries? Did you have 50 countries in this?
We started with a universe of 26 emerging markets countries. So we started with the emerging markets in this because in the emerging markets, there's much more discrepancy levels between freedom between countries. So you have countries like China, Russia, Saudi Arabia, Egypt, and then you have countries like Poland, Chile, Taiwan, and South Korea. So huge.
So this is why France is not on this, for example.
Right. So we didn't do this in developed markets because the developed markets tend to be more homogenous as far as freedom levels.
Yeah. Now, we have had Marco Rubio on this year, the Senator Rubio, from Florida, who's had a lot of criticism of some index construction, particularly MSCI, arguing that he doesn't want government workers investing in indexes that are heavily weighted, for example, towards China, that we should reflect our ideals. How do you feel about that? What do you say to Senator Rubio and his thoughts on this?
Yeah, I can certainly understand where his concerns are coming from, and we share those concerns. We don't, however, advocate for governments interfering in private markets. But the good news is we already have a free market solution for this in what we do, in freedom weighting. So the problem is not with MSCI or with the government fund. The problem is with the way that we weight countries. And in emerging markets, market capitalization weighting just naturally ends up with a lot of weight in China and some of these other less free countries.
And it's very interesting, and I completely agree with you. I don't think the government should be involved in telling what indexes should be in what. And MSCI itself has come out very plainly and said, if they make some regulation that U.S. government investors cannot invest in something that has China in it, we will just create an index for them that will X China out. They don't seem to be that concerned about it overall. Now, let me just ask you about performance. I know we're talking about freedom here, but is there any evidence that countries that are freer than others do better in stocks than those that are not?
Yeah, so we're looking at very long term when we look at performance. And if you look at history, freer markets tend to be more dynamic and less free markets tend to be more stagnant. So you see that everywhere in history. We do expect that freer markets do perform more sustainably. They recover faster from drawdowns, and they use their human and economic capital or their capital and labor more efficiently. So we do absolutely expect outperformance in the long run, but that cannot be measured in days. It has to be measured in decades.
So we've seen Saudi Aramco come to market and is likely to get added to the MSCI index-based products. Saudi Arabia is not one of the countries that is part of the Freedom Index. Is that right?
That's correct.
What's the rationale behind that?
So Saudi Arabia actually has, they're not too bad on their economic freedom side, but their human freedom side, a lot of it because of their women's freedom issues, they have a lot of improvements to make. So we have a lot of hope that they will make those improvements. They are doing some of that now, as far as women driving and going to sports games and things like that. So we hope they will be in the index one day, but right now it's their human freedom side of their metrics that's causing them to be excluded from the index.
Yeah. You know, this is a fascinating question. This is one of these big questions of the 21st and 20th century. We used to, 25 years ago, all of us believed that the economic system called capitalism must go hand in hand with the political system called democracy, that the two are just, they just go together naturally. And yet we've seen challenges to this model. China is perhaps the most obvious one, but even more subtle challenges like Singapore, which is a slightly different democratic system. But in China arguably has been quite successful as a quasi-capitalist system, and yet obviously is not as politically as a democracy. Can you have, I know this is a broad question, but what do you say to those of us who are rather, amazed still that you can have rather authoritarian governments and still have some capitalism, or at least quasi-capitalism that gives the appearance of normal capitalism? How do you argue that?
So economic freedom, or I think what traditionally has been called capitalism, is a prerequisite, but not it's a necessary condition, but it's not it doesn't always lead to human freedom. So we do expect that economic freedom leads to human freedoms at some point, but as you say, that's not always been the case. Now, Singapore specifically, comes up often, and yeah, it's a very free economically, but politically not so much. My friend Melissa Chin, who's from there, calls it Disneyland with a death penalty. So it just matters, what your values are. If you want to be in a country where you can have opportunity, that's important, and that's economic freedom, and we measure that. That's half our index. The other half is human and political freedoms, and that matters as well. Because, yeah, in China, you have some opportunity, which is more than you have in a lot of other countries. And I think that's great. That is great progress they've made on the economic freedom side. But you can't say anything bad about the government. You can't dissent at all. You can't say, oh, we're locking up Uyghurs, things like that. So you can't talk, you can't have freedom of expression. So it just matters, what kind of world you want to live in.
Before we let you go, I just want to put up some of the stocks that are in here. Taiwan Semi, which makes sense. Samsung, biggest company in Korea. Naspers, largest company in South Africa. Santander Bank, also big bank. Honhai Precision. Now, there's one that's Foxconn at the far end. That's 2%. They're headquartered in Taipei, and yet we always associate them with mainland China because they're Apple's iPhone supplier. Essentially,
right.
They're the largest contract electronic maker in the world.
Yeah, so we don't penalize the companies in freer markets for doing business or investing in or having production in less free markets. So we are, highly invested in Taiwan, South Korea, and Chile. Those are all huge traders with China, and they all have, investments or factories that function there. So we don't penalize them for that. They ultimately answer to the rules, the laws of Taiwan or Chile or Poland.
Finally, we got to go, but it's still relatively small assets under management, $15, $20 million along those lines. What do you do to let people know that you're out there?
So we're just trying to get the word out there and let people know that we exist, that there is another solution besides a market capitalization weighting in emerging markets, and that's freedom weighting. So it's extremely new, and we hope that the market will...
It's very new, and it's a very important part of the way people need to look at the world. It's not just about making money. There is ideologies, and we all do stand for something. We're not just here to
it is a way
money
to
grubbing,
stand up for freedom,
nasty capitalists.
Yeah,
well, you might be. I'm suspicious of you over there. Last point.
We're seeing ESG investing become more popular with U.S. investors. This is ESG with the focus on the G in emerging markets.
That's a very good way to look at it.
Our way of doing that today.
Country level ESG.
Very good.
Yeah.
Thank you, guys. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Todd, Kim, and especially to Perth for joining us today, and thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you this Wednesday for a special extra show. Then again next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.